Have you ever stopped to think about how money really moves these days? I mean, beyond just tapping your phone,
Or maybe you've heard the term stablecoins thrown around.
Right, but maybe you're not totally sure what they are or how they might actually affect you.
Well, today we're diving into something happening right now in DC.
Something pretty big, actually. It could fundamentally change the game for digital finance in the U.S. We're talking about the Genius Act.
Yeah, and our guide for this is a really insightful article that just came out yesterday, June 18th, 2025. It's by Frank Mazza. He's the director of blockchain for institutions and Fintechs at Metal Blockchain.
And Frank lays out this idea, this strategic inflection point. That's what he calls it. Basically, a moment where stablecoins could shift from being this niche crypto thing to becoming a core regulated part of the financial system.
Exactly. So our goal here isn't just to read the legislation.
No, not at all. We want to unpack what's really in the Genius Act, why places like credit unions should be paying super close attention.
And what it all means for how money might work, maybe sooner than we think.
Okay, so let's get into it.
So the big picture here, what this act really signals, is that Washington's kind of moved on.
Moved on from if stablecoins are going to be a thing.
Right. The debate now is really about how. How do we make them safe, transparent? How do they fit into the financial rules we already have? That shift is huge.
That is a big shift. It's like saying, okay, these are probably happening. Let's figure out the rules of the road.
Exactly. Integration, not just resistance.
So if you want to issue a stablecoin backed by U.S. dollars under this act, what are the key rules, the must-haves?
Okay, first off, full backing. One-to-one reserves.
Meaning for every digital dollar, there's a real dollar held somewhere safe?
Pretty much. And only in really liquid, low-risk stuff. Think U.S. Treasuries, mostly. No funny business with fractional reserves. It has to be fully backed.
Gotcha. Solid backing. What else?
Also, and this is important, they explicitly cannot pay interest or generate yield.
Ah, so they're meant to be just like a digital dollar, not an investment.
Precisely. Keeps them separate from, speculative crypto assets.
Yeah.
Functionally, it's cash, just digital.
Oh, okay. That makes sense. And what about who gets to issue them and how they're watched over?
Well, the act sets up clear pathways for issuers to register, either federally or at the state level. That gives clarity.
Which legit players probably want, right?
Absolutely.
Yeah.
And then there's oversight, lots of it. Regular audits, public disclosures, proofs of reserves attestations, they call them.
Standard financial stuff, basically.
Right. Plus strict rules on knowing your customer, KYC, and anti-money laundering, AML. And robust consumer protection is built in too.
So bringing that traditional financial rigor to the digital space. But what about the big tech companies? We hear about them wanting to get into digital currency.
Yeah, the elephant in the room. The act actually tackles that head on. There's what they call a big tech exclusion. Meaning non-financial tech platforms, think your social media giants or big e-commerce sites, are prevented from issuing these stablecoins.
Oh, interesting. Why?
The idea seems to be keeping financial activities centered around, regulated financial institutions, leveraging the trust and the regulatory frameworks already in place, rather than letting tech bypass it all.
So banks, credit unions, they're the intended players here.
That seems to be the focus. And there's even a little bit in there about ethical restrictions for political figures getting involved in the stablecoin world. Adds another layer.
Okay, this isn't just talk, though. The article highlights real momentum, 66 votes in the Senate. That's significant bipartisan support.
It really is. That kind of number tells you this isn't just a fringe idea anymore. Congress sees potential here.
Potential for what, exactly? What are the use cases people are excited about?
Things like much faster payments, for one. Think real-time settlements, maybe even internationally. And modernizing how banks settle transactions between themselves, cutting out some of the old, slow plumbing.
Which could save time and money, presumably.
That's the hope. Real-world benefits.
Okay, that leads us right to the credit unions. Why should this be flashing on their radar? You mentioned that strategic inflection point.
Yes, because this framework potentially offers credit unions something pretty unique.
Which is?
The chance to cut costs, maybe hold on to deposits that might otherwise drift away to fintech apps.
Yeah, that's a big concern for them.
Definitely. And improve services for their members. And crucially, do all of this without losing their role as the trusted financial hub for those members. It's about enhancing their position, not just defending it.
So is the idea just to let members hold stablecoins issued by someone else in their credit union account? Or something more?
It's potentially much more. The really powerful idea Frank Mazza explores is credit unions issuing their own stablecoin.
Their own, like a Main Street credit union digital dollar.
Sort of, yeah. A compliant, fully backed stablecoin, but issued by the institution members already know and trust. That's very different from just integrating someone else's coin.
How so? What's the big advantage there?
Control, mainly. When a credit union issues its own, it holds the reserves. Those assets stay on its balance sheet.
So it directly tackles that deposit leakage problem we mentioned. The money stays within the credit union ecosystem.
Exactly. That's a huge piece of the economic puzzle for them.
Okay, retaining deposits is big. What other economic benefits come from issuing their own coin?
Well, think about transaction fees. Right now, credit unions pay interchange fees every time a member swipes a card.
Right, to the card networks, the issuing banks.
Correct. If the credit union issues its own stablecoin and members use that for payments, the credit union could potentially capture that transaction value directly. They own the payment rail, at least within their ecosystem.
Cutting out the middleman.
Potentially, yes, and maybe even generating new revenue. Plus, owning the infrastructure means owning the data and the potential for what's called programmable money.
Programmable money, like money with rules built in.
Yeah, digital dollars that can have embedded logic. Imagine automated payments, escrow functions, things like that, built right into the currency itself. That opens up a whole world of new services they could offer.
So it's not just about saving money, it's about creating new value, new services.
Absolutely. It's about owning a piece of the future financial plumbing, not just using someone else's, building long-term value on their own terms.
Okay, that sounds powerful, but also complicated. What kind of infrastructure does a credit union actually need to pull this off? It can't just be flicking a switch, right?
Oh, definitely not. Policy is one thing. Readiness is another. You need serious tech infrastructure.
Like what specifically?
Secure systems for actually issuing the digital tokens, managing the reserves accurately.
All right.
Robust ways to verify identity and control who can do what. Access control, super important for compliance.
Right, the KYCML stuff.
Exactly. And you need an unchangeable record of all transactions, an immutable audit trail. Regulators will demand that.
Makes sense. Transparency.
And maybe the trickiest part, making it all talk seamlessly to their existing core banking systems. So the digital side and the traditional side work together smoothly.
Yeah, I can see how integrating with potentially older core systems could be a hurdle for some.
It's a major challenge. Many will need to modernize. Legacy systems might not cut it.
So what's the tech solution people are looking at? Is there a preferred platform?
The trend, especially for regulated players like credit unions, seems to be towards private, permissioned blockchain environments.
Private, meaning not like Bitcoin or Ethereum, which are public.
Right. Private means the credit union controls who participates. Permission means you set specific rules and access levels. It gives them the control they need for compliance, risk management, data privacy, all the things regulators care about.
So it's like a walled garden for innovation.
Kind of. A secure sandbox where they can test, deploy, and scale these stablecoins while staying fully compliant. It fits the needs of a regulated institution better than a wide-open public chain for this specific use case.
Okay, so let's pull back to the bigger picture then. This Genius Act, it's not just regulating stablecoins.
No, it feels like more than that.
It feels like it's maybe leveling the playing field. You know, fintech apps have often won because they control the user experience, the rails, as you called them.
That's a great way to put it. They control how money moves digitally, how accounts connect.
And this act seems to be saying to credit unions, okay, here's your chance to build your own modern rails.
Exactly. It's giving them regulatory permission to innovate in that space, to potentially reclaim some of that ground, if they're ready to seize the opportunity, that is.
And the overall direction seems pretty clear, even if the exact details need ironing out between the House and Senate.
Yeah, the article suggests that while there's still process the House has to act, they'll likely need to reconcile the bills. The fundamental direction is set. Regulated digital dollars are coming.
So the question isn't if anymore.
It's really who. Who's going to lead? Who will build the infrastructure? Who will capture the value in this next phase of digital money?
It really positions this as a moment for credit unions to step up, to own the next generation of payments, rather than just reacting or outsourcing it.
That's the core message, I think. Modernize money movement on your own terms.
So, wrapping this up, what does this all mean for you listening right now? We've seen the Genius Act isn't just some obscure bill.
No, it's a potentially foundational.
Right. It's shifting stablecoins into the mainstream regulated financial world. And for credit unions, and maybe for you as a member, this looks like a really significant opportunity.
A chance to innovate, cut costs, keep deposits local, maybe even offer totally new services.
All by using their existing trust and relationship with members to issue their own digital dollars.
Which leads to a pretty interesting thought to leave you with.
Go on.
Well, just imagine, what if the institutions you already trust, like your local credit union, become the pioneers here, the ones actually issuing this new form of digital currency?
How does that change things?
How might that fundamentally change your relationship with money? What kind of new financial interactions could emerge, things we maybe can't even fully picture today, once these regulated digital dollars become part of our everyday financial lives?
Definitely something to think about as this space continues to evolve.